If the October Q3 earnings report call was so up, why is Teladoc stock price so far down? Welcome to MGA Investing. My name is Dee, and I'm going to answer that question in this video. And if you've been watching the channel, you know I own Teladoc stock, and I'm a huge fan of what they're trying to do in the healthcare industry. I think there are several reasons for the recent declining stock price, but before we get there, let me just say that the price of a stock going down doesn't always equate to value loss. No more than a stock price going up indicates value gained. In this video, I'll share with you my thoughts on the reasons for the recent decline, how you might think about that decline, and my position since the decline. Let me start first with the reasons the stock has been declining. One of the reasons for the stock price decline is that it was severely overpriced. The stock peaked at $293 per share back in February of this year, which was unsustainable. But it, like other so-called stay-at-home tech stocks, were riding high on the pandemic tidal wave. Admittedly, there was a lot of hot air in the stock, and that took it to the stratosphere. The next reason is that a value trap was set. What I mean by that is larger institutional investors and hedge funds managers, well, they fled many of the value stocks early in the pandemic to start the pandemic tech tidal wave, which, well, has sucked the air out of the stock prices of many of the value stock companies like Hilton, GM, and others. As a result, the so-called value stocks, well, they bottomed out, and when they did, these same institutional investors, they fled to tech stocks and ran back into the so-called value stocks to pick up all those cheap deals, which shot up the prices of the so-called value stocks as the early institutional investors and hedge fund managers enticed the late uninformed retail investor into the value trap to help shore up the early positions of the institutional investors and hedge funds. Take GM as an example. What did GM do during the pandemic that was any different than what they did pre-pandemic or during the pandemic for that matter that would make their stock more valuable now than it was pre-pandemic, other than to make a bunch of commercials about EVs they're going to make somehow, some way, and someday. These so-called value stock companies, well, they became so interesting not because they developed and launched some new disruptive technology that made them more valuable, but because their stock prices had dropped so severely, thus making them, well, a value. Many of these same companies remained stagnant, clinging to the past, too afraid to look at the future. They have nearly run out of the bags of tricks that they had to pump up the quarterly EPS numbers. Well, they bought back their stock. They've made non-strategic acquisitions using cheap money that, well, will need to be paid back with now the threat of inflation on the horizon. The final reason I give for the price decline is that it's a pile-on. That's what Wall Street is good at. Look, the reality is institutional investors and hedge fund managers need to come back into tech stocks. The world isn't going backward, and they know that. The world is moving forward, and new disruptive companies, services, and products, well, that's the future. If you don't know this by now, innovation more than likely will not be coming from the so-called value stock companies. They can't do it. Kind of reminds me of a video I once watched in high school. Nature videos. We've all seen them. It was about how bushmen find and trap baboons for the purpose of finding water. I think it perfectly illustrates why old legacy companies are less innovative and rarely develop disruptive technology. Watching this film, you can see that if a bushman can't find water, he begins to look for baboons because baboons know where water is better than humans do. To do this, the bushman gets the attention of the baboon by digging a small hole into a mound or into the ground with the baboon watching, because baboons are very naturally curious, and so they'll watch and they'll observe. The bushman digs the hole just large enough for the baboon to reach its hands in. The bushman, after digging the hole, places a handful of melon seeds in the hole, goes in and hides at a distance and waits for the curious baboon to place his hands in the hole and grab a handful of melon seeds. Once the baboon grabs the seeds, the baboon starts to throw a bit of a fit because with his hands clenched around a handful of seeds, it's unable to pull his hand out. The bushman walks up to the baboon with his hands clenched tightly around the melon seed it wants so badly. It's unwilling to loosen its grip and leave the seeds to escape to freedom. From there, the bushman ties the baboon to a tree, gives the baboon several salt crystals to eat for the day, which the baboon loves. The baboon, with its insatiable appetite for salt, begins to lick and eat the salt crystal. The next day, the bushman comes back to a really thirsty baboon and releases it free. Then the bushman, well, it follows the baboon as it very abruptly seeks out its nearest water source because it's pretty thirsty. The bushman now knows where to find water. So-called legacy value companies are much like the baboon with the melon seed. They've clenched their proverbial fists so tightly around what they have in their hands right now, that market share, that they fail to see the opportunities even though they might be right in front of them. Industry is littered with tight-fisted companies holding tightly to the melon seeds. James Dyson, a British inventor and creator of the Dyson vacuum, took his invention of a cyclone-activated bagless vacuum to Hoover to offer to sell them the technology. Hoover, with their fists so tightly wrapped around selling replaceable vacuum bags, well, they couldn't see the future and laughed him out the door. Years later, Hoover would introduce the triple vortex vacuum, a blatant copy of Dyson's design. Dyson would sue, which forced Hoover to pay Dyson over $4.2 million in a patent infringement lawsuit. Now that sucks. You could say Dyson took Hoover to the cleaners. Dyson's revenue in 2020 was $8.2 billion. Kodak, whose own researchers came up with the digital camera in the 1970s, well, they passed on the idea. It filed for bankruptcy in 2012. Blockbuster Video, unseated by Netflix, which started first as a melon video rental company, it had the opportunity to buy Netflix for $50 million back in 2000. Blockbuster filed for bankruptcy in 2010. Netflix, well, it's worth $273 billion today. So Wall Street piles on the bad news. But the reality is, you know it and I know it. These tech companies are mapping out the digital highway of the next 20 to 30 years. So knowing this, you begin to realize that these large institutional investors and hedge fund managers need back into tech stocks. But the problem is, well, they need the prices lower to get back in. So the professional analyst firms that depend on these large institutional investors and hedge funds to buy their reports have no problem sprinkling on a few more negatives to drive the prices down even further. Sometimes their analysis is warranted, but in the case of Teladoc, it seems like they're just doing the institutional investors' bidding to drive down prices. So what do I think about Teladoc's declining stock price and the future of the company in the next 3 to 5 years? Well, in my opinion, nothing has changed except key numbers continuing to improve across the board. Has anything materially changed in a negative way in terms of the way the company operates in the maybe the last 12 months? Has it changed its direction or focus? Has there been a significant change in leadership that causes one to question the direction of the company? Has there been a scandal? Has there been unscrupulous business practices? Has there been a major lawsuit that threatens the company's future? My answer to all these questions is an emphatic no. It has a near durable competitive advantage in the marketplace and its scale. It's now at a scale in its operation that would be extremely difficult for any competitor to unseat. It's clearly disruptive, like Amazon, Tesla, Beyond Meat, and Bitcoin. Like other disruptive companies before it, this is a big bet. If they pull it off, the world's in a better place. The reality is, this is a form of 21st century utility that must be built. Think of what the U.S. healthcare system would have looked like without it during the pandemic. Healthcare must evolve. Information distribution must improve. The consumer must begin to be able to better manage their whole health concerns from doctor to doctor. Don't allow the volatility to scare you. If you're not leveraged into your position, meaning you don't build your Teladoc portfolio on a foundation of sand, meaning credit, borrowed money, margin, time has a good chance of proving you right. The Teladoc journey will require some starts and stops over the next 3 to 5 years. You can bet on that. All I can say is if you can't handle that, you might want to sit this stock out. For me, I just added to my position. If it was good enough to buy at $170, it certainly is good enough to buy under $100 per share. What's your thoughts? Have you been buying or are you waiting for it to move up before buying? Do you think it will dip under $90 per share? Let me know your thoughts in the comments section. If you found value in this video, click that like button and subscribe to get more real information about successful investing for real investors. Thanks for watching. I'll catch you in the next video.